The International Monetary Fund has issued fresh warnings that non-bank financial institutions, or NBFIs, are emerging as one of the more serious vulnerabilities in the global financial system. In its latest Global Financial Stability Report, released mid-October 2025, the IMF underscores how these lightly regulated actors could pose risks not only individually, but collectively to global markets. NBFIs span a wide range of actors: private credit funds, shadow banking units, finance companies, and other lenders operating outside the traditional banking regulation framework. Since the 2008 financial crisis, regulators have paid growing attention to these institutions. Still, the IMF says the pace of growth and innovation has outstripped oversight. Recent defaults by firms like First Brands and Tricolor, both heavily reliant on private credit financing, have triggered alarm bells. The IMF Managing Director, Kristalina Georgieva, emphasized that while these events are not yet creating systemic collapse, they reflect elevated fragility. Markets saw a drop in confidence after these defaults, especially among investors exposed to private debt. Much of the concern centers on transparency. Private credit funds often do not publish full risk disclosures. Many have complex debt structures, with high leverage, cross-exposures, and unclear collateral arrangements. When economic conditions shift, say, higher interest rates or tighter credit, these structures become more vulnerable. Another dimension: these institutions often borrow themselves, or are funded by banks, which in turn might have risk exposure to NBFIs. If non-bank lenders face trouble, those linkages may transmit risk to the banking sector. That interconnection raises the possibility of cascading failures in financial markets. Interest rate policy is also playing a role. As central banks maintain relatively elevated rates to tame inflation, borrowing costs rise for everyone, particularly non-bank lenders with short-term funding. That tightens their margins. For leveraged funds, higher rates increase the cost of rolling over debt. Meanwhile, global debt levels remain high. Governments and corporations both have large burdens of debt. Many non-bank lenders are exposed to both types, either through direct lending or through investments in government or corporate paper. If macroeconomic conditions deteriorate, for example through a global growth slowdown, the capacity to service debt could weaken. In Asia, the IMF has raised its growth forecast to 4.5% for the region in 2025, up from earlier projections. But even here, risks are highlighted: geopolitical tensions, uncertain trade policies, and possible tightening of financial conditions could weaken the outlook. Sub-Saharan Africa is also a concern. IMF highlights that countries there are increasingly relying on domestic borrowing. These borrowings, often from local banks, are more expensive and less transparent. As local banks hold government debt, there's a risk: if governments struggle with repayments, banks could suffer losses. Asset prices globally are also described as stretched. Stock markets, real estate, corporate debt, including in non-bank sectors, are being valued at levels that may be difficult to sustain if earnings do not keep up, or if interest rates move up. The IMF report also warns of possible, disorderly market correction. What does that mean? Sudden, sharp falls in asset values if a trigger, such as bad debt disclosures, tighter monetary policy, or geopolitical shocks, causes investor panic. Another trigger could be fraud or borrower misconduct. Recent disclosures by U.S. regional banks, such as Western Alliance and Zions Bank, of exposure to borrower fraud have rattled markets. These revelations reduce trust and may force banks or lenders to reserve for losses, further constraining credit. The reaction in markets has already begun. Asian shares slid on renewed concerns about U.S. bank credit health. The dollar has weakened in these conditions, and safe haven assets like gold have rallied significantly. Investors are shifting away from risk. However, despite these risks, current financial conditions are still described as fairly easy in many markets. Liquidity remains sufficient, and many central banks still have room to maneuver, if necessary. But the margin for error is shrinking. What must be done? The IMF calls for stronger regulation of non-bank lenders, better disclosure of financial positions, stricter capital requirements, clearer oversight, and monitoring of interconnectedness with banks. Regulatory authorities and finance ministries are urged to act before vulnerabilities grow further. Country-level reforms are also suggested. Emerging economies, particularly those in Africa and Asia, are encouraged to improve debt management, reduce reliance on domestic borrowing where unsustainable, and build fiscal buffers to withstand shocks. For investors, prudence is the key. Diversification, careful assessment of counterparty risk, and caution around private credit and non-bank exposure are advised. Positions in high-leverage funds or shadow banking vehicles could be riskier than previously thought. Looking ahead, if inflation falls gradually, growth holds moderately, and geopolitical tensions ease, the risks may be manageable. But if there is a sudden tightening of credit, or if trade wars worsen, the markets could experience sharp corrections, possibly even systemic financial stress. Thank you for tuning into World Pulse News. Stay informed, stay ahead.